Right, it's 1 minute past 12, so I will begin. Good afternoon, everybody. I'm Emma Senior, the Business Development Manager for Morningstar Investment Management Europe. Thank you for joining us for today's webinar, where we will be discussing the recent banking crisis concerns and hear all about Morningstar's current views on banks and portfolio positioning. Just a little bit of housekeeping before we begin. So you will receive a CPD certificate. This will come after the webinar within 48 hours. You will receive a separate email after, which will include a short summary video of the key points of today's session. Questions, please ask any questions you may have throughout the presentation by using the Q&A function rather than the chat. You can find this at the bottom of the screen. This is a short 30-minute webinar and we will be finished for 12:30. And finally, you will have a feedback form after the session. If you could kindly complete it, that would be great. So moving on, today I am joined by Mike Coop, our Chief Investment Officer, and Mark Murray, our Associate Director of Research. He's been involved in a recent analysis project on global financials, so he will be perfect to speak to you today. Mark will be covering the second half of the presentation, but to begin with, welcome, Mike.
Thanks very much, Emma, and thank you everyone who's dialed in. So before we dive into the topic of banks and what's been happening, let's start with a recap on how banks work and what makes them different. To do this, what I'm going to say is going to be a generalization. And then we'll get into the specifics a bit later in the section that Mark will cover. So as you can see here, the first question we pose is, where do banks get their money? And banks are really simply a business that seeks to profit by enabling others to borrow money from them at a higher interest rate than what banks are paying when they themselves borrow. So banks can make more money when they lend more. They have an incentive to try and lend as much as possible. And obviously when that gap between the interest rate they charge and the interest rate they pay is larger. Now, where do banks get their money from? Well, for retail banks, like an HSBC or an NatWest, they rely on at-call or short-term bank account deposits. But they can also raise money by issuing debt securities, just like government borrows money by issuing debt securities called bonds. The key point here is that banks' source of money or capital is debt, either borrowing from deposit holders, you and I, when we put money in the bank, and in that instance for the depositors, they have to, of course, be able to pay that money back whenever we decide we want to withdraw money. The other element is the debt. So these are what we're referring to as liabilities. These are money which ultimately the banks need to be in a position to be able to pay back. You'll notice at the bottom of the triangle there, a third source of money for banks, share capital. So this refers to the owners of the banks, just like shareholders in any business. They're eligible to receive dividends and have control. This really comes from shares that are listed on the stock market. So companies like HSBC, for example, or there can be ownership which is private. So share capital also includes reinvested profits. So that's where banks get their money from. Let's look at where what they do with that money. So this money, as I mentioned before, the whole purpose of banks is to generate a profit on lending that money. And they can do this in a number of ways. They can classically lend money out to households for things like owning a home, as well as for businesses to fund those businesses, or even to fund the purchase of an asset. It could be, again, it could be an office block, could be a factory, it could be anything. So they're effectively taking the deposit money and lending it out. And what you'll notice is that this lending is much longer term, often than the time period that relates to how they've borrowed the money. So these are long-term loans, multi-decade in many instances. Banks, though, are not only limited to lending that money out, they can also invest it. So they can invest it in traded investments like corporate bonds or shares or government bonds or pretty much any asset. So those things typically are what banks typically tend to do with their money. You'll notice at the top of the triangle, there's also cash and reserves. And this reflects the fact that a certain proportion of the money they raise must be kept aside so that they have some liquid assets should depositors turn up and demand their money. So that, in a nutshell, is what they do with the money to try and generate a return. Turning now to the risks, which is really what's caught the headlines. So there are certain risks that are fairly unique to banks, or where you have a much greater degree of exposure to these risk banks than with other businesses. What we also know about banks is that they've been around actually for centuries. So the risks that relate to them, and we have a long history of what happens when they don't manage the risks. So these risks are known, and to a degree, there are policies in place to attempt to manage these risks. So the two main risks on the left side that I want to draw your attention to are credit risk and liquidity risk. But there's also a third one that we'll touch on, which will be relevant to one of the examples of SVB that we're going to talk about, which is market risk. So the credit risk is really the risk that the bank gets it wrong in terms of when it decides to lend money because that loan doesn't get fully repaid. And there's two elements to this. There's both getting the money back that the bank lent, but also getting the interest, which is due to the bank. So those two components, getting the return of capital and the return on capital. So credit risk, the second of liquidity risk, is this risk that really relates to a bank run. So in effect, not being able to pay deposit holders when they ask for their money back because there aren't enough liquid assets to make the payment. So this occurs because banks fundamentally rely upon short-term funding, the bank deposits that you can demand your money back at any moment. And the fact that their assets, which they own, these loans they've made, they can't sell those assets quickly. Or if they attempt to sell them quickly, they'll have to take a big discount to the value of those assets, so they'll lose money. So they've got that fundamental mismatch. And the third risk I mentioned there is the market risk. So when banks are putting their money they've raised into investments, they're buying investments, if those investments fall heavily in value, and we'll see a bit later, there are some technicals around when you recognize that loss you've taken, whether you can recognize it only when you sell it, or whether you recognize it as it's happening, even though you haven't sold the asset. That can also have an effect on the bank. So those three risks. Now, to reduce the risk of a bank failure coming from these risks, governments provide deposit insurance. This is a lesson learnt out of the 1930s banking collapse, when you had a series of banks that collapsed and people lost confidence in banks. And if you want to have a closer look at that, there's plenty of great examples, including a movie called A Wonderful Life, which is all about that happening. So the bank runs, the governments are basically going to provide a certain amount. So there's a limit to what they will do. In the UK, it's about £85,000 worth. In the US, it's a much larger amount. And so that means that people know that no matter what happens to the bank, they will be able to get that money back up to that amount. The second is that banks are required to maintain a minimum level of liquid assets in order to have some liquid money to be able to provide for deposit holders who turn up and demand their money back. They also need to have a minimum level of share capital, which is intended to meet unexpected losses. And as we'll see, that was a big part of the policy response to the failure in the financial crisis. So lots of ways that regulators try and make sure that the banks have enough capital to deal with bad things happening. And then banks themselves, of course, it's in their interest to continue surviving. So what do? They are if they run well, are wanting to make sure they assess credit risk properly and only lend to those who can pay it back. But to protect themselves, they also will try and secure those loans they're making against an asset which the person or the company they are lending money to owns. So they will take control of assets that the borrowers have in the event that the borrower can't pay them back. Anybody with a mortgage is, of course, familiar with that concept of the bank being able to take that on. So these are the ways, these are the risks that relate to how banks operate and the general mechanisms that apply to how they manage those risks.
Thank you for this, Mike. We want to get a bit more specific, so Mark can cover off what is happening specifically with these. So over to you, Mark.
Thanks, Emma. So I'm going to start with SVB. As we know, this has been in the headlines and has caused a lot of confusion and disruption. And firstly, we just wanted to say that we think that this is fairly idiosyncratic, and there's a number of reasons for this. So I think the first thing to note about SVB is that its client base was very concentrated, both in terms of the sector, so it was mainly VC-backed tech firms, and they also tended to be around Northern California. This sector was especially interesting because during the COVID period and post-COVID, experienced a bubble with asset prices rising sharply. With this, these clients actually had a huge inflow of cash, and unlike a normal bank who could then lend this capital out, most of these customers didn't need loans. So this bank ended up effectively using that increased cash from its customers to invest in government securities. And this ended up meaning that they had a much larger investment book to assets than any normal bank would do. On top of this, there was poor risk management. So not only did they invest in government securities, but they invested in longer maturity government securities, which are far more sensitive to interest rates. So implicitly, there was an assumption by the management that interest rates would not move that high or would stay relatively similar or lower. But of course, we know that that didn't happen, and the Fed did raise rates. So what happened then was these assets fell in value, and there was a panic kind of broke out. And this was especially the case because most of the clients at SVB were actually institutional. So again, unlike a normal bank where there would be a large amount of retail deposits, and because of this, most of the deposits were larger than the amount insured by the government of $250,000. So when the news about losses started to get out, this client base, this very concentrated client base, began to panic and withdrawing all their deposits. And ultimately, this ended up meaning that the government had to intervene. So again, this was a sort of a mixture of poor risk management and also fairly idiosyncratic, unique situations with this bank. Then the other event which was in the news was Credit Suisse. So this was also unique and again, we believe idiosyncratic. And Credit Suisse actually, while SVB sort of in a way came from nowhere, Credit Suisse didn't. Credit Suisse has been known for a long time to be having a lot of troubles. You know, they've had many scandals, many poor investments over the years, many changes in senior management and executives. And unlike most other European banks, they're also loss-making. You know, they have effectively a poor securities business which was losing money. They've had to raise capital, and they had seen previously large deposit outflows. So as the market became more negative with the events of SVB, and as certain other events evolved, such as large shareholders publicly stating that they wouldn't want to do any more fundraising, ultimately the regulator again had to step in, and then it forced the merger with UBS. If we can go to the next slide, please. So we wanted to emphasize here as well that we think banks are in a much better position than they were at the last financial crisis. And therefore, we don't believe kind of extrapolating from then to now is appropriate. So when we look at financials, when we create our expected returns for this asset, we ultimately look at the cash flows of the asset, of the businesses, and then we also look at the risks associated with those cash flows. So as Mike mentioned, there's, banks are, the business model naturally is more risky than other businesses. So we take that into account when we create our expected returns. And despite this, we still think it's an attractive opportunity today. We think ultimately that banks, the balance sheets are a lot stronger than they used to be, and we think they're in a strong position to weather any storm, such as a recession. And there's been rigorous stress testing to demonstrate this. And we also think there's a possibility of improved profitability with a more positive interest rate environment unfolding. If we could go to the next slide, please. So zooming in a bit more on the balance sheets. So following the GFC, the last financial crisis, banks dramatically cleaned up their balance sheets. They reduced their non-lending assets. They ultimately reduced leverage and increased the amount of equity they have. So with this increased equity, this effectively means that they're in a much better position to absorb unexpected shocks, such as recessions or other adverse situations. They also increased the quality of their balance sheets by increasing the amount of the funding which comes from customer deposits rather than other sources. And this chart shows effectively this chart shows the amount of equity to assets for European banks. And the red line at the bottom is the minimum regulatory requirement. So if this ratio goes below that level, then banks would be forced to raise capital. But as we can see, currently it is significantly higher than the minimum requirement, and therefore we think that banks actually have a very large buffer and are in a good position going forward, and much better than in the last financial crisis. So on top of this, the ECB and other regulatory institutions around the globe perform stress tests. So the ECB does this every 2 years. And just for an example of the things they do, in the last stress test, they have very negative assumptions. So they assumed, almost a 4% fall in GDP, almost a 5% rise in unemployment. They assumed sharp declines in real estate prices, so around 30% in commercial real estate and about 16% in residential real estate. And on top of this, they assumed that equity markets would fall by around 50%. So even with these assumptions, at the last stress test, the bank still had enough equity and did not need to raise capital. So it was a positive result. And if we effectively take the results from then and apply it to where the current CET1 ratio is, we'd probably have a drop of around 500 basis points, which would again leave the current banks still in a very good position, even after this scenario. And would still not need to raise capital. On the next slide, we sort of want to focus on a little bit on the profitability and what's happening with the interest rate environment. So as was mentioned, banks, they take deposits, they pay interest to you on that deposit, and then they lend out at a higher interest rate on their loan book. So as banks have struggled, as interest rates have remained low for a long period of time, we're starting to see some positivity come through. So the orange line shows the interest they pay on their deposits effectively, and the blue line on their loans they make. And the gray bar in the middle shows the spread. So the higher that is, it means the more profitable the bank is. So as we can see, as interest rates have risen recently, we've seen that actually the banks have managed to pass on a higher amount of that on their loan book, creating a profit and keeping the interest expense lower. Therefore, they've actually been in a good position lately in terms of profitability. If we look at this chart, we can see as again, reminder, going back in time slightly, that during COVID, banks also sold off very sharply. At this point in time, we also did extensive work on banks, and we came to the same conclusion that they were in a much better position than in the previous financial crisis, and they would be able to withstand a recession or another negative environment. Ultimately, this proves to be correct, and banks held up very well during COVID. Today, we see another situation where the share prices have fallen significantly in this month for financial firms. And again, we feel, rather than panicking with the market, we feel that actually, after doing our own in-depth analysis, that banks are in a good position, and we see it as an attractive opportunity. On the next slide, it also makes clear a distinction that not all banks are equal too. So SVB was a smaller regional bank, and it's worth mentioning that after lobbying and political pressure, actually in the US, they actually changed the regulations following GFC and allowed smaller regional banks to effectively have lower regulations, so they didn't have to disclose as much as the large big banks. Unsurprisingly, these are the banks which are actually in the most trouble at the moment. But at the larger end of the cap scale, the larger banks, we actually see they're in a much stronger position. And if anything, we see they could benefit from this scenario as maybe deposits go from smaller banks to larger, safer banks. And then on the next slide, this sums up this is our expected returns for global sectors. And as mentioned previously, when we create expected returns for each sector, we ultimately look at the cash flows of those sectors and the risks associated with those cash flows to create an expected return going forward. So even with the naturally higher risks that banks face and are included in these models, we still see financials as standing as the most attractive opportunity today, followed by healthcare and communication services. And with that, I'll hand back to Mike to go through some of the portfolios.
Thanks, Mark. Yeah, over to you, Mike. Mark's saying it's quite positive about the financials. So what does this mean for our clients' portfolios?
Thanks, Emma. Yeah, Mark did a terrific job there, just detailing some of the issues that have led to the share price falls and the closure of SVB and the forced takeover of Credit Suisse. As those who are on the call, I'm sure, will know, we're long-term valuation-driven investors, and when we see assets being heavily discounted, we see that as an opportunity. We took that exposure to banks after the sell-off in COVID, and they've actually rallied pretty well. So we've been taking profits for quite some time and don't have big positions. We see the sell-off as meaning that banks and financials in general are offering better value. Excuse me. So in terms of the current environment, we see China, China, Germany, Brazil financials, and communication services. I might just hand back to Mark. My apologies. Just going to have to gather myself.
Sure, no problem. So yeah, as we look at the current opportunities today, as I mentioned, we see attractive opportunities where many other market participants are fearful and scared. And after doing lots of in-depth research, we see opportunities for higher expected returns in China, Germany, Brazil, as obviously discussed today, financials and communication services. And then for other assets which provide greater diversification, benefits to our portfolios. So, all our eggs aren't in one basket, and we can have portfolio returns which are more stable through time. We see higher quality companies offering good protection, healthcare stocks, generally higher quality bonds, and also the Japanese yen, which is, seen as got safe haven characteristics, and is also trading at cheap levels as well.
Thanks very much, Mark. Saved my bacon there. Bit of a cough, so apologies, folks. But so just circling back to the point of the webinar today, we wanted to give you a sense of our view on the SVB and Credit Suisse situation, which, as Mark's highlighted, are very much idiosyncratic and generally speak to poor risk taking, and there will not be lots of copycat situations arising like this. We don't see. And we think that the banking sector has changed fundamentally in terms of some of the protections that are there that were much weaker before the financial crisis. So we think that parallel is inappropriate. And in fact, some of the concerns have been overdone. So we see financials as a better priced opportunity, taking into account all the risks that exist there. So that's really, I guess, in a nutshell, how we're seeing it. We continue to evolve portfolios depending on how opportunities adjust over time. And so we think that it'll be a case going forward of whether we see any further price actions. But the bounce back we're already seeing in financials, is evidence to a degree that these are pretty isolated examples. So with that, I'm going to also mention the fact that obviously you can access all of these investment thinking in our portfolios, the multi-asset funds, and the managed portfolios, which we have further details on in the pack. But as we're drawing close to the half hour, I'm going to hand back to Emma to take us through the questions in the remaining time we've got. Emma, over to you.
Thank you, Mike. So we have only got a couple of minutes left. There is a few questions. I'll ask this to you, Mike. Given the comprehensive research you have conducted, are there any banks that are out?
Well, I'd have to say it depends what you mean by banks that are out there. I think we are not expecting a wave of bank defaults. I think we would see this as the stronger getting stronger and the weaker not faring so well. And so, as Mark's indicated, that is one sign of that is the deposits, where people start to shift from one bank to another. That could well happen. And in fact, in the portfolios, they're dominated by larger, generally better capitalized entities.
Okay, thank you. Another question, is it fair to say that UK banks are safer in terms of the regulatory requirements to avoid GFC, the US or EU, or are they all reasonably even?
I think it's, I'll hand to Mark for any further comments on this. The general trend in regulation has been the same everywhere because the shock of the financial crisis also was everywhere. So the requirement to raise additional capital, extra scrutiny from the regulators, the focus generally has been on larger entities, and that's the same around the world. US banks, have a slightly different business mix, but the things we talked about today are fairly universal. So while at any point in time there'll always be some degree of difference, I don't think we're seeing anything profoundly different for the major players. Mark, anything else you'd want to add to that?
I would just add, as I sort of previously alluded to, I think for the large banks, that's correct, Mike. And then in the US, when there was a lot of political pressure and the regulation changed for the smaller banks, I think that's when the risk came in. But again, that was fairly specific for the smaller regional banks rather than the large banks.
Thank you, Mark. I'm conscious of time. There is a few more questions, but we'll make sure to answer them directly. And I just want to finish off by saying thank you for all your support, and I look forward to seeing you on the next webinar in May. Please feel free to reach out to any of us if you need any questions or you want any support with our portfolios. Thank you.
Thanks, everyone.
Thank you.